Okay, so today we're going to talk about closing entries. The importance of closing entries is to make sure that temporary accounts, our revenues, expenses, and withdrawals are brought to zero at the end of the period. This is the last step in the accounting cycle to journalize and post closing entries and to prepare the post-closing trial balance. So as you complete your adjustments, you create the adjusted trial balance, which we've done. And we've also done the financial statements from that adjusted trial balance. The next step is to take these accounts which are temporary. They only measure activity for a specific period of time. So remember, on the income statement, it says for the year ended December 31st, 2018. These accounts need to be brought to zero at the end of a period so we can start measuring activity again for the next year at zero. Okay, so we don't get confused with previous periods. Now, our permanent accounts, our balance sheet accounts, okay, this should be Alvin here, but our balance sheet accounts are permanent accounts, meaning their balances are going to carry from period to period. Okay? So the ending balances of these accounts on December 31st, 2018 will be the beginning balances on January 1st of 2019. However, these account balances will be zero. So at the end of the period after we make our journal entries and post them and close those accounts, a post-closing trial balance will be done with only the balance sheet accounts. It will just list them as debits and credits instead of in the form of the accounting equation. So how do we do this? Well, the easiest way to do this is to use what's called the REDI method, R-E-D-I, which means revenues, they're closed first, and then expenses, and then drawing, which is the same as withdrawals, it's just a different name for it. And lastly, the income summary. The income summary is an equity account that is used only for closing. It's also a wash account, meaning that at the end of our closing process, it should be zero. So we're never going to see this income summary account on a financial statement or a trial balance or anything of that nature. So I've placed here is I did place the income summary T account as well as the capital and the expenses. Okay, so and the reason why is because they go into the income summary. The withdrawal account does not. That's done separately because it's not part of our earning revenue. It's simply the owner taking out money for personal use. So under the REDI method, the first thing we would close is revenues. So we have a journal, we have closing entries on it, just like we had adjusting entries on the adjusting entries journal. And we're going to start by closing our service revenue. So this balance in service revenue is the adjusted balance. It comes from the adjusted trial balance. It has a credit balance. So in order to close it or to make it zero, we have to debit service revenue. So we're going to do this at the end of the period. We're going to debit service revenue, $35,000, and we're going to credit the income summary. Remember, that income summary is used for closing entries only. Okay, so we're going to credit the income summary with $35,000. That's going to be a closing entry. And then we're going to debit the service revenue account. Again, a closing entry. And that's going to bring it to zero. Now, we're not just going to put zero because that might be mistaken for the result of a transaction. So what we're going to do is just put dashes in there. So we know that the reason it's zero is because it was closed at the end of the period. Our next step under the REDI method is to do the expenses. So our expenses all have debit balances. Okay? So how do we make them zero? We credit them, right? So we can do this in a compound entry. We can debit income summary. Okay? And then we can credit all of our expenses. So we have salaries expense. That has a debit balance of 12,000. So to close it, we would need to credit salaries for 12,000. Our rent expense has a debit balance of 2,000. Close it, we would need to credit it for 2,000. Our supplies expense has a debit balance of 320. So to close that, we would need to credit it for 320. And then finally, our depreciation expense has a debit balance of 550. So in order to close it, we would credit it for 550. And our total will be the debit income summary. So that's going to be 14,870. That number should look familiar to us because that is our total expenses on our income statement. So that should be the same. This debit to income summary, when we close the expenses, should be the same as the total expenses on our income statement. We call that tying, so the numbers tie together. Okay, so in order to close these, again, we've already done the entries, so we need to post them. Again, that makes them 0. And we do that to all of them. Now, the other T accounts would, of course, have to be here. I didn't list them all because I wanted to focus on the closing. But they would be here with their adjusted balances. And then we credit supplies expense. Same thing, make that 0. And finally, depreciation expense. So these accounts will now be 0. And so we can start 2019 with these accounts as 0. And whatever goes into these accounts during 2019, we will know it's for that year and not any previous years. So we use these accounts to measure activity over a specific period of time. Now, we also need to debit the income summary for the 14,870. Now, if we come up with the balance and income summary, we see that we have a credit balance. And that credit balance is 20,130. Again, this number should look familiar to us because that should tie to the net income, and it does. Okay, so if that number does not tie to the net income, then we have a mistake somewhere. Okay? Because it's essentially revenue minus expenses, right? Okay. Now, under the ready method, our next entry is for withdrawals. Again, it's not part of the income summary, so I didn't put the T account here because it's not part of earning revenue, right? It's the owner taking out money for personal use. So if we go over to the adjusted trial balance, we can see that had a debit balance of 3,200. In order to close that, we would have to credit that, and that's going to be debited directly into capital. Because remember, expenses and withdrawals reduce our owner's equity. Revenues increase it. So we're going to debit the capital for 3,200, and we're going to credit Alvin's withdrawal again for 3,200. Okay. And we will post it to the capital account. And if we had the withdrawal account here, of course, we would have to post it to that. Okay, and that is a closing entry. Okay. Now, our last step is to post to journalize and post the closing of the income summary account. So we can see it has a credit balance. In order to close it, we have to debit it. So we're going to debit the income summary for $20,130, and we're going to credit Alvin's capital account. It should be indented. Just copy, paste this. And that should be our 2130. Okay, now when we post this, this will close out the income summary. And remember, this is a wash account, so it has to be 0 at the end of the period. And then we're going to credit capital. Which makes sense, right? Because remember, revenues increase capital and expenses decrease it. If the net effect is positive, if we have net income, that will increase capital. So this is a closing entry. So we have 2 items here, so we have to foot this column. And we get 85,130. And so we obviously have a credit balance. And our credit balance is going to be 81,930. That should be on the balance sheet, right? That should be our capital on a balance sheet. Okay, right here. And also on our statement of owner's equity. So these numbers should tie together. We should be able to say, okay, I've seen that number before. This is the number on the various financial statements. Okay? And that's the closing process. The next step would be to do a post-closing trial balance, which lists only the balance sheet accounts in debit and credit columns. So thank you for your attention.